Hello everyone, welcome back to my YouTube channel. This is Narayan Rao Kovar. In this video, we are going to understand what is the meaning of foreign exchange market or forex market and what are the features and role of major participants, market makers or and passive players, and what is arbitrage, and what are the types of transactions, what are the two types of transactions, current transactions or spot transactions or forward transactions. So now let us examine one by one. Foreign exchange market. Foreign exchange market, it is a wide network of markets and institutions that deal with the buying and selling of foreign currencies. Foreign exchange market is a wide network of markets and institutions that deal with the buying and selling of foreign currencies. This is called foreign exchange market. It is also called forex market. Participants use one currency to purchase another currency. In the foreign exchange market, participants are use one currency to purchase another currency. This is called foreign exchange market. Now, what are the features of foreign exchange market? The features of foreign exchange market are: it is an over the counter market. It is an over the counter market, OTC. That means it is not a physical place. It is not a physical place. There is only narrow spread between buying and selling price. There is a small difference between buying and selling price. Next, participants include commercial banks, exporters and importers, investment institutions, insurance and retirement funds, hedgers, private investors. All are participants in the foreign exchange market. Next, role of major participants. What is the role of major participants? So first one, market makers. Market makers, they set their own price. Market makers set their own price. Commercial banks trade on their own account. Commercial banks trade on their own account. That is called speculative trading. Speculative trading. The daily turnover of large banks often exceeds several billions of US dollars. Next, brokerage houses acts as intermediaries between banks, funds, commission houses and dealing centers. This is the role of market makers. Market makers. Next, that means market makers set their own price. Commercial banks trade on their own account. The daily turnover of large banks often exceeds several billion US dollars. Brokerage houses act as intermediaries between funds, banks, commission houses and dealing centers. Second one is passive players. First one is market makers. Second one is passive players. They trade at prices quoted by market makers. Passive players trade at prices quoted by market makers. Their purposes include, they have some purposes. The purposes include payment of export-import contracts, payments of export contracts, import contracts. Next, foreign industrial investment, foreign industrial investments, opening branches abroad or forming joint ventures. Next, tourism. Next, speculation on rate differences, speculation on rate differences, and hedging of currency risk, hedging of currency risk. All these purposes, passive players trade at prices quoted by market makers. These are the number of purposes include in the passive players. That is why they trade at prices quoted by market makers. Next, arbitrage. Arbitrage means it is the practice of earning risk-free profit. Arbitrage means it is the practice of earning risk-free profit by taking advantage of price differences of the same currency in different markets. This is called arbitrage. In foreign exchange market, if the exchange rate of a currency is different in two markets, at the same time, a trade can. So buy the currency where the price is low and sell the currency where the price is high. Earn profit without risk. This is called arbitrage. For example, in market A, 1 US dollar is equal to 82 rupees. In market B, 1 US dollar is equal to 83 rupees. So, a trader buys dollars in market A because less price or low price. A trader buys dollars in market A and a trader sells dollars in market B. It means in market B price is more. So earns 1 rupee profit per dollar. This is called arbitrage. Next, two types of transactions in the foreign exchange market. Two types of transactions in the foreign exchange market. One is spot transactions or current transactions. Second one is future transactions or forward transactions. Now, first one, spot or current transaction means these transactions take place in the spot market. They involve immediate delivery of currency, that is within 2 days. The exchange rate used in the spot trading is called spot exchange rate. This is called spot or current transactions. That means these transactions take place in the spot market. They involve immediate delivery of currency, that is within 2 days. The exchange rate used in spot trading is called spot exchange rate. Next, second one is forward transactions or future transactions. It is a contract to buy or sell currency for future delivery. It is a contract to buy or sell currency for future delivery. These transactions take place in the future market. The exchange rate quoted for future delivery is called forward exchange rate or future exchange rate. That means it is a contract to buy or sell currency for future delivery, not spot delivery. These transactions take place in the future market. The exchange rate quoted for future delivery is called forward exchange rate or future exchange rate. Next, what is forward premium? Forward premium means forward exchange rate greater than spot exchange rate. That is called forward premium. Second one is forward discount. Forward discount means forward exchange rate is less than spot exchange rate. This is called forward discount. Thank you for watching. Like, share, subscribe, and comment.